And finally, this evening, some news that hopefully you can truly use. With the news today that the GDP was up 2.6%, a sign that at least the core of the country is still holding up. We thought it would be helpful to hear from a real pro. Doug Flynn is a co-founder of a capital management firm, and we asked him to come by and share some wisdom on how we can all manage our way through these stressful economic times, given that regardless of GDP, inflation is still crippling many people. Doug, thanks very much for joining us.
Great to be here.
So does inflation outweigh these good GDP numbers?
Well, it's interesting because the problem with GDP numbers are that only 20% of GDP is goods and 80% are services. So while the services are still holding up, as anybody knows who's doing any traveling or going to restaurants, and so that's holding everything up, even though the goods part has been sort of pushed down by the Fed raising interest rates. Mm-hmm. So we have that battle of trying to keep inflation down, but they're really only battling one part of the entire economy, if you think about it.
Mm-hmm. And in fact, correct me if I'm wrong, but isn't a growing economy a threat to more inflation?
Exactly. They're concerned that inflation will continue on longer, and then therefore what they try to do is, they use the tools in their toolbox, one of which really is only to keep raising rates, as we know. We're expecting them to raise again this coming week, about 3/4 of a point, and then possibly December, January, another 0.5 point. So whatever rates you're looking at, if you're paying home equity loans and other things that you're paying, you're going to be paying a lot more in the next couple of months.
I'm interested in your thoughts about the service sector. You said that's a good sign. But there remains this effect that we're all seeing. All Americans experience this virtually every day, how few service workers there are and what an impediment it is to the economy. Whether you go to get your car repaired or call a repairman or sit on the phone with some service agent, people just aren't there anymore. You go to buy a pair of jeans or something at the department store and everything's out of whack because there are very few people, stockpiling stuff and that kind of stuff. What do you make of it?
That is a problem. Yeah, the problem is, right, even though we have a relatively low unemployment rate, part of that has to do with what's called the labor participation rate, meaning there's a lot of people who left the workforce and they're not counted in the numbers any longer. How convenient for the government to do that, to make the numbers appear better than they actually are if all those people do come back online. There hasn't been the incentive for them to come back just yet because they still have some cash. If you look at all the stimulus money and all the extra money they saved during the pandemic by not going out, they still have that cash cushion. So that hasn't worked its way through yet. I don't think people have gotten to the point where they've worked through all their cash yet to the point where they feel they have to go back to work. Now that will happen, typically on the lower income scale first as it works its way through, but it hasn't happened yet. And so therefore you have this problem of not enough workers to fill all the need that we have, which is also what's keeping inflation a little bit higher than you might like.
Well, Doug, I'm encouraged to hear you say that people will eventually go back to work because I was beginning to think that this was some kind of a fundamental shift in our society resulting from the pandemic, that people are not going back to work. On the subject of crises, I don't know if this is a crisis or not. You can tell me. CNBC reporting that, quote, the technology sector continues its recent woes, in turn weighing down the NASDAQ as shares of Facebook, the parent of Facebook's parent company, plummeted 24% on a weak fourth quarter forecast and disappointing third quarter earnings Wednesday. The company also said it would lose even more money next year building out the metaverse. The report led to several analysts downgrading the stock. What's going on with the tech sector?
It's a great point. What happened with the tech sector was in the last couple of years, there was a lot of money flowing to technology as it kept going and going. And as a result, it became a bigger and bigger part of the market. And one of the things you want to do as an investor is, while of course, you love to continue to have assets that do well, you want to think of other areas that perhaps didn't do well. A great example of that is while all the tech was going on, energy stocks were not doing well. And now that's completely flip-flopped. And so what people are learning is the old story of diversification, that you don't want to have all your eggs in one basket. And so because that grew too much and became a much bigger part of the market than it technically should have, and I'm not saying it shouldn't be the biggest one, there are other areas that will do well when interest rate changes and other things go on in the economy, as we've started to see. So you're seeing a little bit of that. those particular stocks are a little bit more interest rate sensitive, and so they're reacting negatively while rates are going up so much, and other areas are doing better. And that's what's happening in that particular area.
I see. Doug, it sounds to me like, just summing up this entire conversation, I detected just a hint of optimism that things will get better if we just hold on, right?
You know, it's really interesting. I am optimistic in the long run because we do know that things will work their way through. That this is part of recessions, bear markets are very natural. They're good to flesh out the excesses. The problem is when you're living through it, it's not fun. But when you think of it, what's better for the long run, you want this kind of thing to happen. Now, that being said, we could have another downturn on the stock market before you have a long-term upward trend, because it is likely we're going to go into a recession, maybe next year. But on the other side, fixed income, bonds, areas that really got beat down probably way too much, are a wonderful opportunity right now where you don't have to have all the risk in the market, and you can do pretty well with those investments over the next year or 2 years. In the long run, of course, stocks will do their thing. And maybe it's different companies that did well under different administrations. In the long run, yes, I don't think you discount American workers. I don't think they're not going to continue to do what they do and will do well. But in the short run, you have a lot of outside factors causing what you have going on right now.
That's a good note to end on. Doug Flynn, co-founder of Flynn Zito Capital Management. Thanks very much for your perspective.
Anytime.